Well, we're thick in the middle of earnings season, and so this would be a good time to check in on how U.S. corporations are doing. Sam Stovall is with S&P Capital IQ and is back here on Arise Xchange. Sam, good to see you once again.
Good to see you, Andrew.
Okay, so we're getting all of this earnings news. In any big headlines out of what you're seeing so far?
I think the headline is really, in a sense, the big overall number. Heading into this first quarter reporting season, S&P Capital IQ estimates were pointing to as much as a 3.5% decline, which was going to be the first decline since the third quarter of 2009.
These are top-line earnings? Top-line revenue?
Exactly. Not the revenue, but the earnings themselves.
Okay.
This is going to be the first time since third quarter of 2009 in which we had a decline for the S&P 500, and at the same time, 5 of the 10 sectors were expected to show year-over-year shortfalls. But now what we're finding is that management has, again, done a great job of managing expectations to the point where earnings are now inching up close to the positive 3% zone, and really only one sector, that being energy, is in the negative camp.
Is there any tie to the GDP on these numbers? Because we're seeing a slide in the GDP.
They're blaming those that do miss, are really blaming the dollar for this, not necessarily blaming the weather. But when you look and you see that 68% of the companies that have reported have beaten expectations, which is higher than the long-term average of 66%, they really don't have much to complain about.
You said management is managing expectations, but are they managing their businesses, or are they getting these numbers through some sort of financial rejiggering of things?
Well, they're managing the books as well.
Sure.
Mainly because when we look to the first quarter revenue number, it's expected to be down 1.6% on a year-over-year basis. For all of last year, we were up about 3.5%. Right now, expectations are for a more than 1.5% decline for the full year in revenue.
So is this a case, once again, of cutting costs to get better results and not growing your top-line business, which is a story that we have been telling quarter after quarter after quarter for years now?
Exactly. That the companies are now engaging in M&A, mergers and acquisitions, so that they can buy companies that they can then trim down, engage in cost cutting, do additional share repurchases, et cetera. When you have a zero inflation environment, it's very hard to raise prices and therefore help boost the top line.
Right. They have no pricing power. And as a result, we also see no wage growth.
Right, and because of the strength of the dollar, we had the dollar index be below 80 this time last year, now being close to 95.
And I actually have to ask you about the strength of the dollar. When you're talking about multinational corporations, and they all say there's this risk because of the dollar strengthening and what that means to their foreign currency that they hold, are they factoring that in these earnings reports? I mean, are they doing the math so you get an apples-to-apples comparison?
Yes, I mean, everything is on a dollar-denominated basis. And what they're finding is that in this first quarter, because we did have a much higher value of the overall dollar, exports slowed because the cost of our goods were more expensive relative to other international goods. So yes, it is an apples-to-apples comparison, but I find that a lot of the analysts don't, they might sort of guess as to how the earnings might be affected by the dollar, primarily because we don't always have every currency react in the same way relative to the dollar as it did this time.
What sectors were the leaders?
Leaders, we had very strong growth in healthcare, even though we had a sell-off in the biotechnology stocks because they're such high momentum companies. They're showing exceptional earnings growth, so healthcare was among the best. Financials did well, mainly because Bank of America was able to move from the negative camp to the positive camp. Consumer discretionary did relatively well, et cetera. It was really energy and materials, meaning paper and forest products, industrial metals, et cetera, that was slightly in the red.
Janet Yellen said this week that stocks may be overvalued. Your opinion?
I agree with her. When you look to operating earnings, as reported earnings, trailing, projected, at best you can say that the market is fairly valued, but in most of the other observations, it is richly valued, in my opinion.
Over the next quarter, your forecast for stocks?
I think we're in that challenging seasonal period. You don't necessarily want to sell in May, but historically the market has underperformed, up only about 1.4% versus the 7% average gain from November through April.
Sam Stovall with S&P Capital IQ. Thank you as always.
My pleasure.
Coming up, how federal employees wanted to spend your tax money at strip clubs and casinos. What's wrong with that? You're watching Arise Xchange.